This will be, I think, a unique conversation in that we're going to be talking about how economic data may not be as valid a way of looking at things as it used to be because of the structural change in the way that people work. My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is Adam Ozimek. Modeled Behavior is the username, and he's the chief economist at the Economic Innovation Group. So, Adam, for those who are not familiar with your background, talk about who you are, how'd you get interested in markets, in particular in the remote work side of things, and how many video games do you have?
Oh man, hundreds. I've got, I think, about 500 original Nintendo games, and then from a couple other systems as well. Big collection there. I love old video games, and one of the interesting things about my career is I also own an arcade, restaurant, bar. So that's, but I have a lot of interest in business in addition to the economy, and that sort of motivates part of my research agenda, which is new firms, entrepreneurship, starting businesses. Economic dynamism is really what we focus on at EIG. We're a bipartisan public policy organization dedicated to helping to create a more dynamic and inclusive economy. So it's really, dynamism is such an underemphasized part of the economy. How many new businesses are there? How often do people change jobs? How often do people move around? And so that kind of churn in the economy is incredibly important. And that's always been a focus of my research. And part of that is my economics background, and part of that is my personal interest in investments in new businesses. So I hope that helps a little context. I guess on the remote work side of things, I am a remote worker. For EIG, I was a remote worker for Upwork before that. And Upwork is the world's largest remote labor market. So it's freelance focused. And I was the chief economist there for a few years. And that really started my interest in remote work, which was before the pandemic. I started doing research there. So just understanding how does remote work affect businesses, people, and economic geography.
All right, perfect. So let's first focus on the dynamism term for a moment. So you alluded to new businesses, new jobs, churn in an economy. What's been the trend in labor dynamism over the last several decades? Has the economy become more dynamic, less dynamic? Have people altered their behavior because of COVID in a secular way or a temporary way? Just kind of talk about that dynamic for dynamism for a bit.
Sure. So it's, unequivocally, the last few decades have seen declining labor market dynamism. Really, it's dynamism of all types have declined. People are less likely to start new businesses. They're less likely to start high growth businesses, the kind of important companies that become large innovators. They're less likely to do that. They're less likely to change jobs. So they're sticking with previous employers more often. They're less likely to be searching for new opportunities, and they're less likely to move. So in, all the most important ways, there's less change in the economy. And that's, for a lot of reasons, bad news, especially for productivity growth. New businesses are an important way that innovation happens. And it's an important, people changing between jobs is important for them individually. It helps them get better wage growth, find the job that's the better match for them, gives them more bargaining power if they're willing to switch between jobs. And it's also good for the economy. It helps spread knowledge between firms and helps, move the innovation frontier outward. So the last few decades have been bad in that regard, just a consistent downward trend. The pandemic saw an upsurge in a lot of this. We saw people were more likely to start new businesses. They were more likely to be self-employed. We had record increases in new business formation and filing for new businesses. And at the same time, we've seen this insane level of labor market turnover. Quits are higher than they've ever been. People are moving around fast. So what we're seeing, I think, is especially in the labor market side, that's a lot of temporary factors relating to the tightness of the labor market, the lack of workers relative to job openings is a big part of it. But I do think that there are some secular components to it. I think remote work is a big part of that. I think remote work enables entrepreneurship. It makes it easier to start a business wherever you're located because you're not sort of constrained to hiring people in your own labor market. You can hire people wherever they are, and that makes it easier to start a business and also, remotely to find customers as well. I also think we're seeing a bit of a resort in the labor market. People who want to work remote aren't necessarily at the start of the pandemic in jobs where they can. And so they're going to find jobs that allow them to work remote if they value it enough. And we know a lot of them do. And that's going to mean changing occupations, changing industries, changing employers. So that's going to create some secular level of churn for a while at least. And then, on the other hand, you will have other people who they find themselves in a remote job for a remote company. And they're like, I miss being in the office. I'm a social person. I want to be at work. So I think you're going to have a little bit of churn in both directions as people sort of shuffle around to find the right post-pandemic occupation and industry for them.
So I think this is interesting, this sort of downtrend in the dynamic nature of labor markets. And I had Chris Porter on a couple of days ago on Spaces, and we were talking about demographics, and he kind of alluded to the same idea that when you look at different generations, you don't see as much entrepreneurship among the millennials as opposed to the baby boomers. And obviously there's more than one factor to that, but I'm curious to hear your explanation for why that trend has been lower over time. Is there an element of fiscal policy, of monetary policy that created the conditions for less dynamism?
That's a great question. I think there are a bunch of drivers, but if we think about what's the biggest factors that we know, demographics is an important part of it. So population growth has slowed down, and that means labor force growth has slowed down. And there's a big geographic inequality component here too, where large swaths of the country are actually pre-pandemic, we're seeing population fall substantially, and we're seeing prime working age population fall even faster. So it's if you're living in one of those areas, thinking about which cover 2/3 of the country, shrinking counties, you're thinking about starting a new business. What you're facing is, well, I've got fewer customers literally every year, and I've got fewer workers every year. So basically, you're going to have to take every new customer and every new worker, you're going to have to peel them away from existing incumbents. And that's just not a great environment in which to start new businesses compared to being in a place or time when population is growing, when the labor force is growing. That's a much more conducive environment to entrepreneurship, and just we're seeing a lot less of that. So that's a big part of it. There's other angles as well, like it might be aspects of the nature of innovation. There may be more advantage to being a large company now than there was in the past. Economies of scale, stuff like that. Intellectual property potentially plays a role. Other things like non-competes potentially play a role. So it's not one single thing, but I do think the biggest factor, especially the biggest factor that we have an ability to influence, is going to be around demographics.
Yeah, and that makes sense. I don't know if you've done work with looking at other countries where demographics are more favorable. Is this sort of a global phenomenon, or is this primarily centered around developed aging economies?
Well, the aging economies is a global phenomenon too. So is slowing population growth. But there is evidence of slowing dynamism other places, but it's much easier to measure and identify in the US. And what you can see is counties or metro areas that are seeing population growth slow more are the ones where dynamism has declined more. So that if you're looking for a good, strong empirical relationship that really proves the point, it's within the US county level data that really shows it.
Okay, now you alluded to one of the reasons is economies of scale, large companies becoming larger, and it becomes admittedly harder to compete, right? Which I'm going to imagine that for a lot of entrepreneurs that might have some idea, they say to themselves, listen, I want to try and create a business, but what's the point? Because somebody else will come in and copy what I'm doing very quickly because they've got the resources and I don't. How does this sort of, and I've used this or talked about this theme before in prior spaces, the nature of pretty much nearly every industry being kind of an oligopoly, really run by 2 or 3 companies, right? How does that impact not just entrepreneurship incentives to start businesses, but also that point about sticking to your location, right, physically? Because if jobs are primarily coming from Amazon, as an example, what's the point in going somewhere else if that somewhere else also would be hiring from Amazon, if that makes sense?
Yeah, so it can cut both ways. I want to be clear, and this is somewhat more speculative. There are examples where the big national company moving into the local labor market increases competition. So, for example, you take the growth of Walmart and their expansion, and other big box stores, their expansion into the grocery industry over the 90s and early 2000s. That reduced profit margins in the grocery industry. And so that increased competition. So along one lens, you can say, well, this is you're getting more and more dominance by Walmart and other large firms. Like that's a reduction in competition, but at a local level, that manifests as greater competition. So it's not in as neat and tidy as saying like, at the entry of a few dominant firms is necessarily going to be anti-competitive or bad for workers or anything like that. But I think where it does happen, where it can happen, there's definitely the possibility of that relationship. You don't want to enter a space because it's dominated by a handful of large incumbents. Some of that can be, anti-competitive. Some of it can just be like the nature of the industry. If you're talking about high economy of scale industries, that means it's cheaper for big companies to produce something than it is for small companies to produce it. And that sort of is going to, naturally lend itself to less competitive outcomes. And yeah, that isn't great for entry. The hope is that the pressure becomes enough, those incumbents, they try to raise prices and increase margins enough to lure more competition in. But, I certainly am wholeheartedly in agreement with the program of how do we make the economy be more competitive? How do we increase competition? And thinking about policy levers there. But we have to be careful about conflating, big companies with lack of competition and vice versa.
Yeah, that's fair. And to your point, it's complicated. You can make an argument, and I've made this point before, that the real way to solve supply chain disruptions is with competition. And you can't really have competition if the cost of capital is beyond elevated, right? Which is sort of the direction we're going. So you have this kind of strange dynamic where you want to create conditions for competition, but at the same time, you're not in a place where you can do that with cheap, easy credit like you used to.
So you're saying like, low interest rates as good or bad for competition?
Yeah, I would argue as good, right? Because it would encourage more risks taking from entrepreneurs, assuming you had fiscal, support also to some extent.
Yeah, it's tough. It's hard to hold that factor in isolation without thinking about the indirect effect, which is like, are you holding interest rates low enough to keep the economy at full employment? I would say that's going to be good for entrepreneurship. But you might have low interest rates, but they're not low enough. For example, like if you look at like, 20, post Great Recession up through 2015, interest rates were at zero. So you might think, well, that's a very low interest rates. That must be good for entrepreneurship. But interest rates weren't low enough to get the economy at full employment. We were at the zero lower bound. And I do think an economy that's at full employment is one that's going to be much more conducive to competition and startups and things of that nature. So I think there's something to that, but I would focus less on, cost of capital and more on like, what's the underlying state of the economy that interest rates are helping deliver.
Yeah, I think I've heard you make that argument before that post GFC, the response actually wasn't enough with hindsight, which is why we ended up having this zero interest rate policy for so much longer.
Yeah, exactly.
Okay, so let's go back to remote work because I think it's an interesting broader trend. I think coming out of COVID, all the excitement around remote work and this idea that it was going to forever change the way people operate was that it would help people's psychology, right? Because they can spend more time at home if they have kids, because time with their kids, and they don't have to worry about commuting, so they save time too. But I think there was also this argument that it would be perhaps disinflationary and beneficial for company earnings because now you don't have fixed costs in terms of having an office. How do you view remote work in terms of whether it's an inflationary or disinflationary force? With the caveat that all this is still fairly new, we don't really know sort of the extent of things, and we're in an abnormal environment. But how do you factor that into sort of the inflation-disinflation debate?
Great question. I think there's probably a different story if you're talking short run, long run. So short run, I think remote work is something that is generating demand for housing right now. People want bigger houses. They're less likely to want to live with roommates. They're more likely to want to live with themselves. And over the last 2 years, that's been a major driver of demand for housing. And obviously that's going to be inflationary, right? Especially when in a time when we're dealing with reduced supply so that the housing market can't really respond quickly to it. That's going to be an inflationary factor. In the longer run, though, I think that what remote work is going to do is allow people to move to lower cost of living places. And that's already the result that we're seeing in the evidence. So you can, like the places where people, if you look at population change post-pandemic, it's the most expensive places that have seen the greatest declines in population, and less expensive places have seen increases in population. So I think remote work, allowing that disconnect between where people live and where they work, making it so that you have more job opportunities throughout the country without having to necessarily move into these superstar cities with their really dense labor markets and also their really expensive housing markets. I think that long run is going to be a positive factor for cost of living and inflation.
But that conceivably could, from a local perspective, create some frustration or widening of local wealth gaps. So I was just in Idaho doing a presentation in Boise, and I was talking to people that were attending the presentation, and we were talking about the real estate market there. And they noted that prices have gone vertical and that they're slowly starting to come down now. And a lot of that's because money moved or people moved away from California to go to Idaho because it's a cheaper standard of cheaper cost of living. But the real thing which is interesting to me was across the multiple people I spoke with, there was this frustration around that because the price of everything suddenly started rising as this influx of money started coming in from California. So the locals basically don't want people coming into the state because it makes everything more expensive for them. So you do have this other, I think, interesting dynamic in terms of, yes, there's a relocation to cheaper areas, but then those that are in those cheaper areas now suddenly can't afford things like they used to.
I think there's going to be something of like a trickle down effect, but it takes a little bit more time. So immediately people move to kind of the most obvious places, right? Which are the places where people were kind of moving already when they were leaving those housing markets. So Boise was not like a weak housing market pre-pandemic. Like it was already a place that was getting some California exits. They moved to the most obvious places, and then the costs go up in those obvious places so much that people start being pushed towards like second tier, third tier places, and they start, sort of moving down. And I think that we're going to see more of that. I think we already have seen some of that. I think a lot of people move to Austin and push Austin prices up really high, and then they start looking to other parts of Texas, for example, and Austin stops benefiting from as much population growth. That's one thing that's going to help us deal with that in the long run. The other thing is that a lot of places are going to be having to think harder about their zoning. And if you're a place that's not accustomed to growth, then inefficient zoning policies might not have been a big deal for you for a long time. But now when you're dealing with population growth, possibly for the first time in a while, you may be dealing with negative repercussions that are caused by not a population growth per se, but population growth alongside zoning rules, which make it difficult to build new housing. So I think those are the two most important things, like seeing this sort of non-obvious, non-immediate places begin to benefit more from population growth and population trickling down, and also taking a harder look at zoning laws in these places. And we need the YIMBY movement, as it's called, to start looking outside of the superstar cities, which I know they are doing.
So the implication there would be, from a longer term perspective, that average affordability for housing on a nationwide level would probably be more elevated than pre-COVID, right? Because one of the arguments as to why housing is so expensive and why affordability is so low is because there's not much inventory. It's not just a function of cheap, easy credit. It was just a function of people, to your point, not wanting to move, or if they move, they basically move to a bigger place to have their remote work dynamics in place. I want to hear your thoughts on the state of the housing market and where the mean really should be if it's higher than historically it was. Because I think one of the arguments around housing here is that it's overshot on the upside. You're going to have a mean reversion moment. Of course, the problem is you have to figure out where the mean is.
Yeah, great question. It's always historically very difficult to say, for example, okay, this is the correct house price to income ratio, right? It's not easy. A lot of people's forecasts have been wrong over time, as a result of taking a strong stance on what the right price to income ratio is. So it's not something that's extremely knowable, but it does seem that like the run up we have seen is not really sustainable, and that there is a correction on the way. Now that correction can come from stronger income growth that catches up to rents and house prices, or it can come in the way of falling house prices. My suspicion is we'll probably see, house prices that just lag income growth for a while can be a part of it. So I think we're going to, and we already are seeing, some negative price pressures in some places and house prices coming down. The increase in interest rates has obviously rapidly lifted mortgage rates, but those things take time to manifest as price declines. I think we already are seeing people drop the pricings of listings and we're seeing houses for sale stay on market longer. But home sellers tend to be kind of loss averse, meaning that they'd rather let their house sit on the market at what they thought it was worth, rather than drop prices too much. They start to think of that wealth in their house as something that's theirs and they don't want to give it up. So it's going to take a little while for housing to normalize, and prices are going to lag a little bit. But I expect that the negative impact of the increases in interest rates is going to continue to unfold in the housing market. We're going to see more places with prices falling, but I'm not expecting anything like the post Great Recessionary housing crash, because at the end of the day, inventory is still low, reflecting we haven't really destroyed demand. We've just tried to bring it more in balance with supply.
Right, and I think, and I've made the same argument myself. But at the same time, to your point, ownership on rent's a big deal, a big percentage of CPI. You need to have housing break inflation, and if that's only just starting, then it doesn't seem like it's going to be easy to get out of this higher average inflation, and that it's probably going to stick around for some time then.
Well, it's a really, here's the real paradox right now. If you think that the CPI for housing is going to converge with the more market-based rent. So if you look at like Zillow's rent index or Apartment List, their rent indexes are well above the CPI for housing. If you think they're going to converge in levels, we got a long way to go. But if you look at rent growth, Zillow and Apartment List have shown rent growth levels come way, way down. And so those are already heading towards zero. They're heading to declines. They're not there yet, but there's a lot of uncertainty there about what the CPI for housing is going to do. Is it going to follow the more current market-based rents down, or is it going to play this long game of catch-up growth for the time being?
Yeah, no, and I've used that line before. I mean, personally, I don't think the bear market in stocks ends until the bear market in housing ends, and that's still pretty early, right? So it's just more of in terms of the interaction of the two. And I've made this point before, but the whole reason why my right eye on Twitter on my profile is lumber is because of the link to housing, right? And housing is obviously a big driver of economic activity. So it's just interesting how this year in particular, there's a lot of asynchronous movement. Usually housing will precede a recession, then stocks will follow in a substantial way. This time it's actually stocks first, and bonds, obviously. And now housing is starting to respond. So there's a lot of kind of funky asynchronous timing, I think, in the cycles going on now.
Yeah, and I don't think all of the stock market movement is is not purely being driven by recession risk and interest rates either. Obviously, I think there's some overvaluation of tech there that you can't really pin to recession risk. That's a part of it as well. So I think that's part of the asynchronousness. But I would look to in looking at past cycles of what's the soft landing look like here in terms of housing markets, stock markets, and the real economy. If you look back to 2018 was a time when the Fed was raising rates too fast. It was having a clear negative impact on the housing market. You could see it in the aggregate data, and it was causing the stock market to panic. But the Fed was able to, see that happen, realize they were getting ahead of themselves, and reverse course without a recession actually happening. So, not that we're going to see the exact same synchronization there, but that basic story playing out is kind of what I'm hoping for.
One thing that to me is interesting, I want to hear your thoughts on this, is the notion that when it comes to the labor market, the idea that Keynes brought up, right, that wages are downward sticky, right? That's hard to really have wages drop in a big way, but presumably with remote work and with technology, it may be less sticky. Right. In other words, you could see more competition. You could see, and I've used Upwork for years, right? And I know it's not impossible to find relatively less expensive freelancers to do the same kind of quality of work as somebody else. And there's always a growing pool of freelancers as a result, right? So talk about how remote work may impact this kind of idea of wages being downward sticky.
Yeah, it's a good question. I think, if you think this downward stickiness, if you think a lot of it is just in people's willingness to just wait out and not wanting to take a lower wage, the real change here is going to be on the ability to find a job faster, and also the ability for better geographic matching. So when a demand shock hits the economy, it doesn't hit the economy spatially equal, right? If you look at the trade shock from China, like there was huge spatial inequality there. Like some places got hit super hard, and some places like did well because they had, strong export growth at this time. If you look at like the Great Recession, the housing bubble, that didn't hit all places equally. Some places saw like, Arizona, for example, saw like California, much larger declines in housing activity because they had seen stronger, bubbles on the way up. One of the things that remote work does is it allows like places where the economy is strong and places where the economy is weak to be more equalized, because you can, as a firm in a strong economy place, you can hire more workers in the weak economy place. And so you don't have like parts of the country lagging behind, and you don't have places where, like, for example, they're waiting longer for like, market wages to catch up with their nominal wages. So it's easy to think of like, a guy in a manufacturing area and he gets disemployed when there's like a labor shock, and he says, I make $15 an hour. I could go out and find a job for $8 an hour now working in a convenience store or something, but I'm going to wait until the nominal economy catches up to my reservation wage, my nominal reservation wage. And if that shock is localized and the US economy is like doing fine, then he's going to have to do that in the context of 2% wage growth, which could take a while. But if instead he's able to look for jobs outside of his labor market easier, where the economy is booming, then that's going to be much easier. So I think of that geographic match, that stronger connection between weak and strong labor markets, and the ability to smooth the demand shocks out, local shocks out. I think that's the primary way that we're going to see the business cycle impacted by remote work. And you can think of that in sort of manifesting in a nominal sticky wage growth way, in the sense that, like, absent nominal sticky wage growth, we should just have local equilibration anyway, right? But like that's sort of what causes the need for the geographic shifts.
Yeah, reset the room for the remaining half an hour here. First of all, everybody here, make sure you follow Adam at Model Behavior here on Twitter and check out his various research. Again, if any of you want to ask questions, click on that bottom left mic request button, and I'll try to bring you up. Follow me, check your DM so we can coordinate. And as usual, I'll have this as a podcast on Lead Lag Live on all your favorite platforms, catching up, getting there with all the prior conversations. Okay, so I'm curious to hear about age brackets for a moment here, Adam. This idea that, as people can work from home and as more jobs are available for those that want to work from home, those that might be near retirement, that don't want to physically go somewhere else, but are still active mentally, want to still be in the game. So maybe they offer their services online in ways they couldn't before. How does this kind of broader trend of remote work impact retirement ages? Because I have to assume that as technologically savvy generations age, they're going to be working more just to keep mentally active, at least online.
Yeah, I think that's a really, really great observation. If you look at the self-employment rate amongst workers who are older is much higher. And I think this partly reflects growing demand for older workers to stay connected to the labor market to some extent, especially as, if you're working in like an old line industrial firm, you're probably not going to want to work past retirement age. It's physically demanding kind of job. When retirement comes, you want to retire. If you are in the knowledge economy, you are much more likely to want to stay engaged in the labor market, to want to be employed to a lesser extent. And we see that through higher rates of self-employment. And I think you can see the remote work connection here, which is like today, the remote work labor market is disproportionately freelance and contractual based, just because that's the part that got there first. And so it's easy to imagine a lot of older workers who are like, okay, I'm going to continue to work for this accounting company that I work for. I'm going to switch to a contractor status. I'm going to become a freelancer, and I'm going to do it remotely. So I'm here, I'm available to help on a part-time basis. I can, continue to usher through projects that I was working on. I can continue to be like sort of a mentor role, available to help sometimes, but, on a part-time remote basis. I do think that we're going to find that to be a growing feature of the labor market.
Let's get some of the audience up here.
Yeah, I think if you look at where the employment rate has not recovered to pre-pandemic levels, it's definitely lower education level workers, whereas college educated workers have seen their employment rates return. And so I don't disagree with part of the premise, which is that inflationary pressures are being exacerbated by a relative shortage of lower skilled workers. I don't think that remote work is a major driver there, because if you look at the propensity to work remotely, it's relatively low among those with lower education levels. It's a very education biased phenomenon, and that those with advanced degrees have the highest rates, and then college workers, and then people with high school or less than high school have relatively low rates of remote work. So it's not that there are no opportunities for people to work remotely with lower education levels, but they're relatively scarcer.
Although it's interesting, right? Because I mean, that was part of the, or probably is still part of the appeal of the metaverse and everybody working with Web 3.0, right? The idea that you could do things that would otherwise be manually intensive, right, remotely, if you have machines doing it, and you're simply able to do it in some kind of virtual world. So I mean, that's a long ways off, I think, but that would have presumably other implications on the labor force.
Yeah, so if you I think a good example of this would be if you think of like self-driving cars, for example. They may be a time when they're not fully self-driving, where they get into a situation where the AI doesn't understand the situation, and so it goes to a remote driver somewhere who then can like navigate the situation. So you might have a guy at a computer somewhere who's like responsible for 1,000 remote vehicles, and he gets like dialed into them remotely occasionally. That's an example of something that would be a job that wouldn't require a high level of skill and could be done remotely if that technology gets to that level and seems plausible. But in that circumstance, I think what we're going to see is when that happens, it's going to manifest as a huge increase in productivity in those sectors. So I don't think that's going to be inflationary. I think that's going to, increase output and productivity in those areas and decrease real prices.
I'm curious if there I always like to try to think things in terms of unintended consequences of trends that maybe people don't see obviously. When you think about sort of the longer term trends when it comes to the labor force, how we work, what are some of the positive and negative unintended consequences that maybe people are not really focusing or talking too much about, but are starting to percolate? I'm just curious if you've given any thought to that.
Yeah, I think it's a really important question, and I do think that's the right way to be thinking about it. I think the obvious things are, a lot of them are still underestimated, but I think people are coming around to the obvious things. And if we're talking about something that's like the invention of the automobile or electrification in terms of being a general purpose technology that has these sorts of broad impacts, it's really important to be thinking like that. Like, what's the indirect things? Not to get too far afield here, but like an example of this throughout history was like the invention of electrification helped to create department stores for the first time, because you had the ability to have elevators and you had the ability to have small fans and lots of lighting. And so like it's a very indirect thing. It's not like when Edison turned the first light bulb on, people are like, oh man, we're going to have department stores now. It's like the kind of thing that takes time for innovation and technology to really ripple through society and create these new types of things. So in terms of like what's coming for remote work, I think that one of the really interesting ones is new communities, new places. And I mean something along the scale of like, retirement, how retirement communities became new types of spaces, new types of places. I think we're going to see the potential for remote work communities to become new types of spaces and places. You look at like parts of the country where people didn't live there before, mostly because of a lack of access to jobs. And they may have other desirable features, but it's hard to get like a skilled job there. And so not a lot of people live there. I think we can see the possibility for new types of places to exist there. And it's not just that like those are going to be new places, but you have to think about the form. What's the form of those developments going to be? And I think it opens up a lot of possibilities for rethinking, housing developments in sort of far-flung places. So that's a positive unintended consequence that we'll see. I do think there are going to be more longer commutes for some people, and that could create traffic in some places. And that like you have offsetting effect of, hybrid workers are driving less. So it's really, where do the long distance remote commuters more than offset the decline in hybrid commuters? It's not going to be even everywhere. And in some places you might end up with some more traffic or longer commutes and worse outcomes for environment. I do think we need to, in the places that are seeing more remote workers, I think we're going to need to see adaptation to the flow of them in terms of their housing markets, like we talked about. Otherwise, you will end up with what are going to be, for some people, the negative consequences of being crowded out of those housing markets. I would say in terms of like businesses, the biggest challenge they have to face is how do you onboard and train younger, new remote workers? That's like a big challenge. still a TBD.
Yeah, it's interesting. It makes me think of like almost like the villages in Florida, right? But having it be for for high tech villages, so to speak, right, where it's less about golfing and more about access to good technology and good broadband, right? Just kind of an interesting way.
Exactly. Yeah, like so that's a perfect example. So how is the villages? How different are they from a traditional worker / family oriented housing development? Like pretty substantial, right? Like it wasn't just that like, oh, these neighborhoods are going to fill up with old people and that's how they'll be different. It's like they were rethought. The amenities, the layout, the design, the housing, it was all rethought. The geography, it's all rethought based on this change. And I think we need that sort of rethinking. Yeah, it's a great example. Great question. So I think of what's happening on Upwork. It is entrepreneurship. It is people starting their own companies. There are a lot of it doesn't just allow you to become an entrepreneur on your own. There are ways on the platform. I would argue there should be more and better ways, and that the evolution of the remote labor market will lead to this. But you can grow a firm on the platform, start an agency, hire remote workers from all over the country, all over the world, and they work for you as freelancers, and you're the freelancer running the company together. So I think that is entrepreneurship. I don't think it's crowding it out. I think it's leading to more of it. Now, there's an open question about whether the success of that. So it's easy to start like a 4 or 5 person, remote firm on Upwork. Is that crowding out like a higher level of entrepreneurship where someone would scale that company? I think that's a great question. And I would love to see, platforms evolve and adapt to allow truly bigger companies to exist in the digital labor markets and in digital spaces. So if you think like Shopify is a great example, right? Like there's no firm limit on Shopify. Shopify lets you start small and grow all the way up to like being a major producer. And so we don't have that yet on the labor market side, but certainly on the product market side, I think platforms make entrepreneurship easier entry and then also easier scaling all the way up. In terms of, local co-ops and stuff like that, I guess I need to hear a little bit more about what you're thinking there. But I do like, you're talking about like self-sustaining communities and small ones, and you're talking about like living off the grid in communities. I think you described it perfectly. It's clear how remote work allows people to do this, but probably too small to be picked up by the data. It's less of something I'm expecting we're going to see as like a lifestyle choice, but certainly something I think we are going to see more of. It becomes so much easier to be relatively independent when you don't have to live a certain distance from major labor markets. Yeah, good questions. I've done a bunch of research on both of these issues. So I think that in terms of like offshoring to other countries, to cheaper cost countries, my answer is yes, that is going to happen, but it's not going to play out as people who are more pessimistic think. The US has a competitive advantage in skilled services. We have a really highly educated population. And not only that, but we're the world's largest consumer market. And companies all over the world want to know how to reach US consumers. They want to sell to us. They want to make products for us. They want to advertise to us. They want to create media and reach us. And so I think that's a really important way in which remote work will help create demand for US workers all over the world. And that may sound like, kind of far-flung speculation, but I did some research using Upwork data. And what I found was that US workers on the platform earned a premium even when they were hired by firms outside of the US. So companies outside of the US are willing to pay a premium to work with US workers, and they're more likely to hire them as well. So I do think this is not like, when we lost a lot of jobs to globalization over the last 2 decades, the primary driver there was like we were doing work that was low skilled, and low skilled work is going to end up in developing countries where they have this massive labor cost advantage. Developing countries, they aren't known for their skilled services as much. I think we will see some of it for sure. And already some of it happens, on Upwork. People hire freelancers from Eastern Europe. They hire freelancers from Africa. They hire freelancers from Asia. So it does happen, but we have a competitive advantage there. And I think we're going to, continue to see even greater opportunities for remote work. Yeah, I hear you. I think it's a great question. It's certainly an extremely plausible hypothesis. So what we can see in the data so far, what has been studied, is that if you're a small town or non-metro rural area outside of a major urban area, those places are definitely seeing the benefit of remote work. They're seeing house prices go up. They're seeing population locate there. So there is something about having that, 2 to 3 hour access those more expensive metro areas that we can see. I have not seen anyone test whether the presence of an airport or public transit or something access to those major cities, whether that is a positive factor, but it strikes me as very believable. And I would definitely like to see someone look into that. Maybe I will. We are already seeing the effect there. It's interesting. There's a sort of contradiction in the data where if you look at surveys of the percent of workers who are back in the office, that's creeping up over time. It's now about like 50% of office workers are back in on any given day. On the other side of the ledger, though, commercial real estate vacancy rates are as high as they've been throughout the pandemic. They're at high levels. So I think what's happening is some workers are coming back in the office. That makes it might look good short run for commercial real estate. But at the end of the day, businesses are dropping their leases. They're shrinking their square footage, and that's driving up office vacancy. The real divide here is going to be between what we've seen in Arpit Gupta's research is between like top tier commercial real estate and kind of everything else. So like Class A office buildings, like really new Class A office buildings are actually doing pretty well. They're doing fine. One of the things is that if you are spending a lot less on office space because you can shrink your square footage, there's more willingness to spend more per square foot. So you're more interested in that Class A space. Your workers are only going to come in, twice a week, once a week, something like that. You want nice space to lure them in, and you can afford it since you're shrinking your square footage. So Class A doing seemingly better. Everything else really struggling. And I don't think that those struggles are over because a lot of businesses are on longer term leases and the shoe is still dropping there. I would divide the answer into 2 time periods. So pre-pandemic, we didn't see like a really, really high rate of self-employment. So if you look at like self-employment is measured by the BLS, where they ask people, are you self-employed? That's where you would capture a lot of the sort of like single firm entrepreneurship, sole proprietor kind of thing. It's not like we had some massive surge of that would be like, oh, well, that's where all the missing corporations went. So I don't think that is like going to explain overall the decline in people with like faster growing big companies. I do think though that it is the case that it's become harder to scale in some ways. And part of that might be related to, the decision to go public, I think has become more difficult, with Sarbanes-Oxley and things like that. And just, greater barriers to becoming a corporation, I think, is one of the factors that holds back growth of large firms, more new large firms. So I would say what you're saying is not going to be, what you're identifying there is not going to be something that explains most of the decline, but I do think it is a factor, this various frictions to getting much larger as a business. Yeah, I mean, I think it's a possible mechanism. I just think that if what we were seeing was small entrepreneurship crowding out big entrepreneurship, we would have seen stronger gains in small entrepreneurship. But since we saw both of them decline, I just don't think that can be most of it. But I will say that I do think that the impact of, presence of small business lending or the lack thereof, concentration in small business lending, lack of new banks, obviously we didn't have a new bank form for years in this country after the Great Recession. And there still is growing concentration in finance and declining new bank formation. I think those are potential important mechanisms for lower dynamism. I just don't think that they manifest mostly as lowering the bar for sole proprietorship. I think they manifest as raising the bar for small business formation overall.
I really do appreciate your time, Adam. Everybody enjoy the rest of your day, and thank you everybody for participating here. Thank you, Adam.